guys, Natalie here with Claudia Tax. I wanted to talk to you today about the real estate professional status and go over a recent tax case that relates to this and really points out everything you shouldn't do and kind of what they look for when they question the status. So real estate professional, if you haven't seen the first two videos related to this, go back and watch the video on how your rentals are taxed, how passive losses are used. That'll kind of set the groundwork for this video. Okay, so we mentioned it briefly in the last video on passive losses, but real estate professional is a status where basically if you work 750 hours a year in real estate, and this is important, and if you don't spend any more time on any other activity than your real estate, any other combined activities. So this is what messes most people up, is that the 750 hours a year is pretty easy for most people to log, but if you work a full-time job or if you run a business, there's a good chance they will disallow this because you're spending more time on other things than you're reasonably spending on your real estate. So let's start with that. The next thing to consider is rentals, right? So the benefit of real estate professional is that it doesn't limit your passive, your rental losses. So if you have a good job, right, where you're making 200 grand a year and your spouse stays and manages your properties, or your spouse is a real estate agent full-time, then they qualify for real estate professional. And only one of the two people in a marriage need to qualify for both to get the benefit because you file together. So what qualifies as a real estate activity? Being a real estate agent. You have to work full-time in real estate if you're a flipper, but keep in mind, there's no benefit to the status unless you own your own rentals. So if you own rentals, how do those qualify? Well, as a standalone, the rentals are each looked at as an individual activity, right? And no one is going to have 750 hours a year in any one rental property. Very, very unlikely. So there is an election you can make, right? There is an election on your taxes that says, I want all of my rental properties, all of these to be looked at as one activity, combine them. I want to count all of my hours for dealing with all of my rentals, lock them up. That's what we have to do if you are trying to count your hours based on your rentals. But here's the downside that gets overlooked a lot. If you've had those rentals for a really long time, if you've had them for 10 or 20 years and they had passive losses that you couldn't take during that time, right? They were captured. Like we talked about in the earlier videos, normally when you sell a rental property, those prior losses become available the year you sell, right? If you make this election to combine these rentals together into one activity, those losses are now stuck. So now if you have 20 rentals all lumped together so that we can count your time together for Real Estate Pro, and you sell one, and that one you've owned for 20 years and it has $50,000, $60,000 of losses from prior years before you qualified for Real Estate Pro, they're stuck. We can't do anything until that whole unit of all 20 rentals is disposed of. So keep that in mind before you blindly just elect real estate professional, that any earlier losses will no longer be available when that specific one rental sells. You now have a unit of 20 rentals, right? That whole unit needs to sell for those losses to become available. Something I've seen, and I actually just had someone reach out to me about yesterday, another tax professional that they just saw. And this was actually a client that came to them from a big firm, like one of the firms that you hear about on like at real estate trainings and stuff. So just know that it can happen anywhere. It can be overlooked anywhere. This was someone who was a real estate professional, and this is what I saw recently too. My client has been full-time in real estate for 7 years. Started off doing flips and wholesale, but in the last several years, like last 5 of those 7, has had rentals. And their prior CPA did not elect a real estate professional. They didn't look into this. So he had like $40,000 of losses in these years that he could have used, right? He could have deducted those every year. So it's something that, especially if your tax professional doesn't like specialize in real estate, they might not even think to ask you. They might not even try to qualify you. So you got to kind of be your own advocate sometimes. And that being said, this is something that is questioned a lot by the IRS, right? It's a great benefit. You get no cap on your rental losses. Like, that's a huge benefit. So they're going to look at it. So don't try to force this if you don't qualify. But holy buckets, if you qualify, take it. like make sure you're getting this. So if you know that you only do real estate, if that's all you do, and you get your taxes back and you have a passive activity loss carryover on there, if there's a worksheet for that, if it shows that you had rental losses but they're not letting you use them, right? If you see that carryover schedule, that means your losses are being pulled to the next year. Talk to your tax pro. Ask them why. Ask them if you can qualify for real estate professional. Okay, so just be aware of it. So those are the two big things with it. Only one person needs to qualify. Both people get the benefit. Have to spend more time in real estate than anything else. And that's normally what this gets caught up on. Normally when we see tax cases, it's because people claim and they had the hours, but they're actually also a doctor. So the tax court throws it out because like that's what you spend most of your time on. This case is interesting to me because it was the hours that they questioned. So we'll go through that in a minute. So like I said, you have to have those 750 hours. It is your responsibility to track those hours on an ongoing basis throughout the year. So what they do not want to see is come December, do not try to reconstruct a log of these hours. You should be doing it ongoing as you're doing the work. You need to track the taxpayer and spouse hours separately. Okay, so it's not a combined hours for both of you guys. It's one person's total hours have to hit 750. And there's weird things that do and don't qualify. Looking into new properties won't qualify you. It has to be day-to-day involvement on current activity, right? So if you're a real estate agent, you're probably good if that's what you do full-time. But if we're using the rentals to qualify you, it has to be involvement on those current properties. A few weird caveats is that your drive time counts, okay? So keep that in mind. This can be a huge add-on for hours. Your driving time qualifies. So you need to track those miles for deduction purposes. That's separate. But now also track the time you spend in the car related to the rentals, okay? Something important, commuting doesn't count. It doesn't count for these hours, and it doesn't count for your deductible miles. What's commuting? Same thing you did when you had a job. If you're going from home to work, doesn't count. So if you just go from your house straight to a rental to pick up rent, doesn't count, commuting. The way we get around this is if you have a dedicated home office. So that'll be a whole nother topic, but if you qualify for a dedicated home office space, and that's where you run your real estate business, now you're going from a workplace to a workplace, and it does count. So this is why having a home office is important. Okay, small sidebar. So your hours count, your driving hours count. The financial involvement, like you're reviewing your financials, going over monthly reports, all of that qualifies as long as you're also involved in the rental. You know what I mean? So like if you're involved in the day-to-day of the rental, running it, managing it as a whole, you can also count your financial time. You can't have someone do everything for it. Maybe it's a syndication or it's totally hands-off and then you just look at reports each month and count those hours. That doesn't really count. So those are kind of the weird things that people get caught up on. So keep in mind it has to be all of your ordinary and necessary management activities of your rental properties. And so we're going to jump into this tax case, okay? So this was Hairston versus Commissioner. This was the Tax Court Memo 2019-104 if you want to read the details of it. And there are several things they did kind of right but wrong that ultimately cost them this. So in this case, this was a husband and wife. The wife still worked full-time, husband was retired. They both logged hours. They had over 360 entries for the year. So that seems like a really good log that they were keeping. There was over 930 hours recorded on there between both of them. So their argument was that him alone had far exceeded the 750. The IRS came back and they said that they only found 660 hours for the husband and like 170 for the wife, and the other 93 were unclear. So this is why it's important to be really precise with this log. I know it's kind of a pain, but it's a huge benefit, and if they question it, this is where they're going to nail you. That's what happened with these two people. So they had over $55,000 in losses that they had deducted over the years they claimed this, and it got disallowed. The tax court made them pay it back. So you want to make sure you don't make these mistakes and you stay up on your time log for this. If you visit my website, colotax.com, I actually have a download. It is a time log for tracking your real estate professional hours. and it directly mimics the log they use in the IRS audit guide. So this is what an auditor is going to basically fill in to sort of question your involvement. This is what their log looks like. So this is, like, if you follow this and fill it in completely, this will help cover your butt. So go check that out, colotax.com, real estate professional time log. So in this case, like I said, the wife worked full-time, husband managed the property. Few things worth noting. The properties were all next to their house. They only had two rentals. So that's already like 750 hours on 2 properties is pretty hard to hit. And they were next door to him. So there was really no drive time. It was a two-second walk, right? They're literally the properties right next to him. There was a garage between 2 of the properties. That was kind of a shared garage space. Like, it was centrally located, but the tenants didn't have access to it. This was just where the landlord kept all his tools, his cars, his exclusively. So another thing worth noting was what the lease said versus what he was logging hours for. So another mistake they made was in their lease, it states that the tenants are responsible for maintaining their own driveways. They're responsible for maintaining snow removal, and they were responsible for the overall kind of landscape of their own personal lawn driveway, right? Like their area around their house. In his logs, there were quite a few kind of discrepancies with that. So he had logged, we find here, over 105 hours for snow removal. Well, if your paperwork literally says you're not the one doing it and you record 105 hours for it, they found that super suspect. So they pulled that. Those hours also included, he included a bunch of time for removing snow up that main road to that main garage. Tenants didn't have access to that, right? So that was disallowed. They threw that out. They're like, maybe a couple hours you had to go in there to get the snowblower, maybe because it's your garage, but you weren't maintaining rentals the whole time you were clearing snow to that garage. That wasn't rental. The other error was that there was a bunch of kind of entries related to this that were planning, right? He had a third of his hours related to snow removal were planning for the storm. They were preparing and deciding how to remove snow. So maybe a little bit of time to that, right? Like, you're trying to figure out if you should shovel or go buy a snowblower this year. It takes you a half hour, maybe an hour researching snowblowers. But a third of 90 hours, a third of 105 hours total, it's too much, right? They didn't like that. Tax court said, this doesn't cut the mustard, right? They weren't having it. These are kind of my favorite things about this. This was another huge mistake he made. He recorded the majority of his tasks. Every task took at least an hour. All of them. Huge red flag for the IRS. Huge red flag for the tax court. So over 36 of his entries were exactly 1 hour. Exactly an hour. What are the odds of that? Right? They weren't having it. So you really need to actually look at how long something takes. A bunch of his, like 36 of them that were 1 hour. Keep in mind, these houses are literally next door to him. 1 hour. Collecting rent. Collected the rent. Took an hour. Had to walk next door. There were a bunch recorded for reminding tenants to pay rent. Had to walk next door. Let him know rent was due in 2 days. That took an hour. No, it didn't. Tax court knows it didn't. So these are things that they look at. So these were huge red flags. He had all these 1 hours. Paying the mortgage. 1 hour. I don't know about you, but I just log into my bank online. Takes 5 minutes. So these are the things that they, like I said, they kept this long log, right? Like, they had a bunch of entries. They put a ton of time into it, but a lot of the entries just they weren't reasonable. You've got to be reasonable with what you're putting in there, right? And the tax court, they're going to question this. So he had all of these things that were exactly an hour, and they were things that take no more than 20 minutes. So all of that, they kind of threw out all that time. They're like, there's no way, right? Not reasonable at all. My favorite thing was he had a bunch of hours related to work being done on the properties, right? They had a tenant move out, had to fix them up. He had over 33 hours logged to watching contractors install and clean carpets. Now, if you have contractors working on your properties, you can kind of use that time, right? If you're supervising someone working on your behalf, you can count those hours, but you have to be reasonably involved for that time. So if he had recorded just the time of when he selected the new carpet with the installer and checked in twice a day on progress, called over or like walked over because he's next door to see if they had any questions, stuff like that would be reasonable. but just watching them the whole time didn't have any benefit, wasn't a necessary item, because also the properties were vacant. That was another issue the court brought up. If these were occupied properties and someone had to be there to let the people in and out, they were going to be coming and going all day, they wanted to make sure none of their tenants' property was damaged, okay, maybe. But these were just empty houses, and he said he had to sit there and watch everyone 30 hours. This is my favorite part of this whole tax case. Get ready for this. He said he spent 40 hours supervising contractors, okay? Just supervising them, sitting there and just watching to see if they had questions, making sure they didn't mess things up. And the tax court said, no way, no way. They called it being on call at best, right? And that doesn't count, right? Just because your tenant could call you at any point about a property doesn't mean you get to count 24 hours of the day. Kind of the same theory here. They said, nope. And literally what they said on this was that the court found that even though Mr. Harrison, being retired, had some time on his hands, it wasn't credible to believe he spent an entire week watching paint dry. That made me crack up when I read it. I feel like there's some tax court accountant sitting somewhere right now who felt really good about that. He got to kind of retire with a great dad joke. So that just cracked me up. So what they found was that, like, no, that's not reasonable. You're not going to sit there and literally watch paint dry as people paint walls of your house. You might stop in, make sure the colors are right, and then you're going to go about your day. So these were the biggest mistakes he made on this. Like I said, a lot of kind of rounded times. Another issue they had, they didn't take a huge issue with it, but they mentioned it, so it was worth it. Like, it bothered them enough that they put it into the court finding, was that some of the recordings, like some of these hours, were recorded the day they were incurred, but there were quite a few that recorded like at the end of a week or the end of a month, and that's not what they want to see. They don't want you going back and reconstructing. So they want daily entries. They want you to stay on top of it, track your hours, put in reasonable times for things. Don't round everything up. Don't say you're doing stuff that you're either not or you shouldn't be doing per your lease, right? If the lease says they should be removing snow and you put 100 hours to removing snow, which is it? So you just need to make sure everything lines up. The more properties you have, the easier this is to prove. Obviously, the more hours you'll spend, but you've got to track it. You've got to track it, and it's got to be reasonable. Unfortunately, there's not really an inclusive list of what activities qualify. Like I said, the big thing is what they've disallowed, and that's any time spent looking into new properties. Like if you're researching, you can't just sit on Zillow 5 hours a day and look at, rental meter and try to figure out new rentals. That won't count. But if you're collecting your rents each month, you are going by and doing a maintenance check once a month, you're going over and fixing something for your tenant, you are doing your monthly QuickBooks reconciliation and looking at financials. So anything like that, that's kind of ordinary, necessary hours that show involvement, you are good. You need to track these ongoing basis. Like I said, visit my website at colotax.com. I've got a download for you. It mimics the IRS's audit log for real estate hours. So this spreadsheet will help you track. It's going to let you choose who did it, what the time is, what activity it was spent on, and it's designed to do on an ongoing basis. So it'll keep you from getting in trouble if you're ever audited for this. So that is my summary of this tax case. I just thought it was super interesting. It's the first one I read where their, or one of the only ones I've read where their issue was more with the actual log than their time being spent more elsewhere. Because realistically, even with 2 properties, it could have been potentially doable for him to hit these hours, but he just inflated so many others and called so many things an hour that obviously wouldn't be. So if something really only took 15 minutes, put it as 15 minutes. These are things they're going to question, they're going to disallow it. So thank you guys for listening in. I will put a link to the actual tax case below in case you are having trouble sleeping and want something to help cure your insomnia. I've got tax cases for you. Thanks for listening in, and stay tuned for the next video.